Now, while some of today's economic reports were dismal, there was a glimmer of hope for the housing industry. Mortgage applications jumping 4% last week as borrowing costs declined. My first guest knows a bit or two about the home lending business and also the rest of the economic environment. He's the former chairman of Prudential Home Mortgage. We're joined now by Larry Swedroe. He's a principal and director of research at Buckingham Asset Management. And Larry is also the author of the book entitled The Quest for Alpha, the Holy Grail of Investing. Larry, it's great to have you with us. Thanks so much for coming in. All right, so this idea of the housing industry, I want to start there.
Okay.
Have we seen the declines that we're going to see, or are we going to get even further declines in the prices?
Well, I like to tell people there are no clear crystal balls. And while I always have an opinion, I don't think you should put much stock in it because the evidence, as I present in the book, The Quest for the Holy Grail, is there really are no good forecasters. What I can tell you is the historical evidence from research on past housing crises. There was a recent study on about 15 of them, and they tend to last a lot longer than people think, with housing prices not recovering for as long as 5 to as much as 10 years or even longer. So I think we probably have seen the worst, but we're probably not near the bottom, and prices are probably not likely to turn around much for maybe another even 5 years or longer.
So if you use that historical information, we've got another 5 years of potential price declines.
Or at least not strength.
At least not strength.
Right.
What do investors do?
Well, I would always tell people they should never buy a home as an investment. Housing has been a lousy investment for over 200 years, except for very brief periods. Rate of return has been virtually zero when stocks have gotten much better returns. Even treasury bills have gotten you about the same return. So you buy a house as a consumption item, not as an investment item. So you should treat it the same way now.
But wasn't housing viewed really as an investment because it was financed by cheap money? And we've got cheap money now.
Well, that's true. That's what leads people to make mistakes. Whenever money is cheap, people start to take too much risk. Eventually, you blow up because you get bubbles. We may be having a bubble right now in gold and silver, oil. People forget how rapidly prices can fall. It often takes years for bubbles to build up. Gold went from $35 to about $850 in 1980 from 73, and within about 2 years or less, it was down over 70%. Silver, in a shorter time period, went from roughly $50 to under $5. And just recently, we've seen, not for the first time, oil went from, I forgot what the high was, maybe 160, went down to under 50 in 2009, and now it's back up to 125. Very quickly, prices can fall. I remember when oil hit $40 a barrel the first time in the 70s, and very quickly it dropped back to $8. Whenever you get prices above sustainable levels, above the marginal cost of producing anything, that's a sign that a bubble is there. It will burst. It's not a question of if. It's only a question of when.
We're talking about the direction of markets and what investors should be looking out for. My guest is Larry Swedroe. He's a principal and director of research at Buckingham Asset Management. He's also the author of the book entitled The Quest for Alpha, the Holy Grail of Investing. Larry, I was describing how you don't really believe that there are any great forecasters out there, yet the media, the investing public, seems to anoint someone or some group at every turn of events and say, well, they predicted the last collapse or they predicted the last rise. They must know what they're talking about.
Well, first, I've had a long experience running trading rooms for some of the largest institutions in the world. On top of that, I've consulted with some of the top economists in the United States over the long term. And I've read all the academic research on forecasters, and the evidence says very clearly there are no good forecasters. And Warren Buffett says, if you don't want to believe Larry Swedroe, says an economic forecast tells you more about the person than the market and its direction. So the evidence says there are no good forecasters, and what's even worse is the evidence from a new study by the Federal Reserve of St. Louis found that the forecasts, when they're needed most, are actually worse, and they're bad all the time, and that's when markets or economies are turning. So we don't care if the market's going to, or the economy is going to grow 3% and it grows 3.2 or 2.8. We want to know if it's growing 3, that it's going into a recession or it's about to turn around. At those turning points, economists get it really wrong. They cannot forecast the turning points at all. So that's one point. And that's why I tell people, The object is not to do what everyone else does, which is to try to manage returns, because forecasting is so difficult. Instead, you should focus on the things that you actually can control, which is the amount of risk you take, diversifying those risks as much as possible, keeping your costs down, and keeping your tax efficiency high. If you do that and build a globally diversified portfolio using passively managed funds, even Warren Buffett will tell you exactly what I tell you. You're guaranteed to outperform the majority of professional investors, hedge fund managers, mutual funds, pension plans. It doesn't matter.
All right, it sounds great, Larry. So how do you do this? We were talking about value stocks and value investing, and this idea that when you make a value investment, you invest kind of with a cushion, figuring that you bought it for so cheap that it can only give you those kinds of good returns.
Well, yeah.
What do you say?
Well, the good news is you don't have to be Warren Buffett or some other famous value investor. The market's already done that for you. All you need to do is buy a group of stocks that have their prices are distressed. You can look at them as low PE stocks. Maybe you buy the stocks with the bottom 20% or 30% lowest PEs, or the highest book to markets. They're trading at liquidation values. And the evidence shows from every study ever done, okay, is that active managers, whatever the asset class is, whether it's small or large, value growth, emerging markets, all the stuff about inefficient small cap stocks, it doesn't matter. Active managers persistently fail, and there's no evidence of persistent outperformance beyond the randomly expected, so you cannot rely on the past performance of an active manager to predict the future. And I go into some great examples in the book, The Quest for the Holy Grail.
Well, in this quest for the Holy Grail, this idea of getting alpha, which is the return in addition to whatever the market produces.
Or the risk you're taking.
Well, that was where I was going, was this idea that people are willing to take risks that they don't necessarily understand.
Oh, exactly. We know one of the things that hedge funds do is they, in effect, tell white lies about the risks they're taking. So they compare their benchmark to something like an S&P 500, and if they outperform that, they claim alpha. Well, in fact, they tend to invest in much riskier securities, highly illiquid securities. They invest using leverage, all things that add more risk, and therefore you should get higher returns. But that doesn't mean you generated alpha. It meant you took more risk. Once you adjust for all these risks, the evidence on hedge funds is so bad that they have had a hard time keeping up with the risk-adjusted returns of Treasury bills. All they've done is transfer money from the wallets of the country club set to the wallets of the purveyors.
Well, having said that, then what is a regular investor to make of the heroes of every crash and every bull market?
Right.
Because we talk about them, you try to read about them and emulate their behavior. Is that just a fool's errand?
Well, it is a fool's errand. That's what the research shows. Nouriel Roubini is a great example. He forecasted the recession in 2008 and 09. Of course, he'd been forecasting for a long time. You know, blind squirrels occasionally find acorns. But in March of 2009, when the market hit its bottom, it's up 100% or more since then, depending upon the asset class. Roubini was then forecasting another drop of about 30%. In May of last year, when the market had started to go down a little bit, he was saying this isn't the end, it's going down another 20%. I kept that forecast because I like to hold people accountable, and I'm writing about it for my blog shortly. And of course, the market turned around very shortly thereafter and is up big since then. Everyone likes to believe, it seems to be a human need, that there's somebody out there who can protect us from bad things. I tell people there's only one person who knows where the market's going, and I'm not going to get to speak to him in this lifetime, and the next one it won't matter anyway. So stop listening to forecasts. There are no good forecasters. Even Peter Lynch, one of the great active managers of all time, said this. He said, far more money has been lost anticipating bear markets than ever lost in them. And he was always 100% invested.
I want to thank you very much, Larry Swedroe, really shedding some light on the way that forecasts are used and abused by the investing public. Thank you very much. Appreciate your insights from Buckingham Asset Management.